I didn't expect to be talking about an unboxing when it comes to the Fed rate cut, but I think it definitely deserves that kind of a headline. Well done.
Yeah. No, I think so for sure. Because again, it was a very surprising week, very anticipated, and then what they ended up doing, I think, got a little bit of everybody's attention since it was stronger than expected.
Well, I remember back in the day, and you probably remember this because we're fairly close to the same ages. There was that old saying that says, "When E.F. Hutton talks, people listen." And I think it's the same thing with Chairman Powell, that, when he's going to say something, people just kind of put the brakes on and stop. And as I told you, I said, it's very rare that I ever actually stop and listen to a news conference from the chairman of the Federal Reserve. And yet I couldn't turn it off because I'm like, this is crazy. What's going on? And the fact that they cut it a 0.5 percentage point was a nice surprise. Well, I don't know if it's a nicer. I think it gave this, you tell me, did it give the markets a mixed signal?
Well, I think a little bit. And by the way, as to your point about Chairman Powell, you're right about that. In fact, that's what's always a little bit, you got to be kind of careful and watch this process, because they do these 2-day meetings, Tuesday, Wednesday. Then after the meeting concludes, that's when they announce the decision on the rate. And of course, this week it was dropped by 0.5%, not the quarter that was predominantly expected. But then part 2 to that is then after the announcement, Powell holds a press conference where he gets riddled with questions, and the press is going to try to get him to kind of expand on what was behind the decision, what reasons were taken into account to go that far or not, and so forth and so on. And so sometimes what you can see is an initial market reaction when the decision has been announced, and then more market reaction, which can go either way once Chairman Powell starts talking, because they really focus on that very intently, and they start parsing his words and, okay, what does he really mean here? And it's amazing how the markets can read into some of his comments, and then you see a reaction either in the stock market or the bond market as a result. So it's really kind of a fascinating process.
Yeah, I kind of thought I would see because I was kind of flipping back and forth to say, okay, after he's talking, what's happening to the stock market? Right. And I was surprised to see it losing some ground as it did. I thought, the investors say, okay, this is a good thing because it really potentially frees up some money for these people who have been waiting for those loans on projects and things of that nature and mergers to now take action. And right. I was surprised it lost some ground. Now I think today it's back on positive ground, but that was interesting.
Yeah, for sure.
So the other thing I want to ask you is Fed Chairman Powell said, we don't think we're behind in this rate cut. What do you think he meant by that?
Well, part of what's been in the news lately, last week or two, as we anticipated this meeting and the decision, was a fair amount of criticism that the Fed's been late, that this process of starting to lower the Fed funds rate should have happened earlier, like basically in July. We've had some politicians, some senators have been really critical that the Fed's behind the curve and they should have cut rates a lot earlier. So he was, in his remarks, in his press conference, he pushed back on that and basically said, no, we're not behind. That's not why we did this. But he also went on to say, well, we're not behind, but in part we're doing this so that we don't get behind. So that's the kind of subtlety in language that the market can really focus on. To try to, figure out what do they really mean and where do we go from here. I think, when the announcement was made, you're right, the stock market kind of sold off a little bit. And I think the initial reaction is, oh my gosh, maybe things are worse than we thought, because the Fed went 0.5% instead of a quarter. So maybe the economy is tanking. And so I think that was the initial reaction that you saw with the stock market. And of course it recovered today because it's really not that simple. It's not that clear that the economy is falling apart and things are going to start to go into a real dive. I don't see that. Maybe it's softening up a little bit, but I don't think we have anything severe going on in terms of the economy, at least not yet.
Well, one thing he said that I thought was very important is he said, when we go behind closed doors, he said, we're making decisions based on one thing, and that's data. And he said, that's why we waited as long as we did, because the data didn't support a rate cut. And when they said, well, what kind of data are you talking about? And he kept giving us the data points that supported his decision, that if there were one of those reporters, there were 10 that asked, does this mean the economy is softening? And what was his response to that?
Well, no, in fact, there's a particular focus with the Fed on the job market, because in respect to how strong or how weak the economy is, the job market is a very big focus. And there's other factors like we talked about just a minute ago. Retail sales were up, still growing, but with the job market, he actually made a point of saying, no, the job market is actually still doing pretty well. So he was very firm about the fact that they don't see any major issues with the job market. The unemployment rate is up a bit. It was mid threes, several months ago, and now it's around 4.2, 4.3. But at the same time, he's saying, look, you've got to factor in other factors like labor participation rate. That's always been a big one for me. I can remember from my days, because I have a piece of paper that suggests I know something about this. But my economics classes, labor participation rate is a big factor in terms of evaluating the unemployment rate, because those who choose not to participate in the labor market, who choose not to go out and look for a job, they're excluded from calculating the unemployment rate. So if you have a labor participation rate that's soft, it can inflate the unemployment rate, but that's not really the true story. So you have to be careful with that. And he was pointing out, look, there hasn't been a lot of layoffs. We don't see companies planning on a bunch of layoffs. We're still seeing a pretty good labor market overall. Like I said, the unemployment claims came in well below forecast this week. So when you look into all of the data, then you get a more balanced view. And I think that's why he was pushing back and saying, no, we don't see a major problem, at least not yet, in terms of the economy and the labor market.
Yeah, I think that's a good point, because he did mention about, again, on those questions, no, the economy is strong.
Yeah.
And so the next question is, well, if the economy is strong and they gave a 0.5 point cut yesterday, what is the outlook? And again, I'm asking you to open up your crystal ball. You've got over 4 decades in this industry, so I think you've got some good track record of, what does the next rate cut look like? Is it something going to happen before the end of the year?
Well, that was part of what came out of the end of the meetings and his press conference. The market at this point pretty much has decided. I'm going to say decided because nobody knows, but the expectation now is that we're going to have likely 2 more rate cuts by year end. And again, I always hate to say rate cuts or a cut in rates. What we're talking about is the Fed funds rate. There's an expectation that the Fed is going to lower that 2 more times this year. Well, the next one isn't until November, the day after the election. And that's expected to be 0.25%. And then another 0.25% in the last meeting of the year in December. So you can then expect another 0.5% decrease in the Fed funds rate if that bears out and turns out to be true. Now, again, I would caution everybody, even if that does turn out to be true, you don't want to fall into the trap of thinking, well, that means mortgages are going to go down by a similar amount. You should not think that way, because that's not how it works, at least in terms of long-term fixed rate mortgages, 15, 20, 30-year loans. Different story if we're talking a HELOC, home equity line of credit. Since most of those are tied to the prime rate is directly correlated to the Fed funds rate. So, another 0.5% at year end will help those HELOC borrowers, because the rates on that particular loan type will or should drop. In fact, this week was good news for any homeowner who's got a HELOC. You should therefore see on your next monthly payment statement, you should see that interest rate on your HELOC statement should reflect a 0.5% lower, because the prime rate does follow suit to the Fed funds rate.
He also talked about, when they go behind closed doors, that they're looking at the data, because some people say, wow, how politically motivated are their decisions? And he had an interesting say on that. Remember what he said?
Well, I don't remember the verbiage exactly, but he basically was trying to establish the fact, look, when we're behind closed doors, again, we're data focused. We could care less what's going on with the election, who the candidates are. That's not our role. That's not our mission. And I think that's basically true. So there's a lot of talking heads out there, and of course the candidates like to make those comments about, this is all political and so forth and so on. But you know what? These folks are professionals. They're paying attention to the data. That's what drives their decisions. And I believe them. I think that has shown to be the case, not just now, but over the years. So the Fed really isn't as political as I think people think it is. So,
yeah, I like how he said, if you look at democratic systems around the world that are something like the U.S., he said their monetary systems are protected as basically non-biased. They're separate from the political aspect, he said, because we don't want to give any party, one way or the other, any chance to control the monetary system. He said that would be a disaster. Well, I'm not sure he said a disaster, but he said, but that would be good. And he said, so we don't answer to anyone when it comes to which political side.
Yeah, you cannot have the Fed having any involvement by the politics side of things. We can't have the Democratic, Republican, whatever, whoever's in office. You cannot have them having any say directly or indirectly. It's got to be an independent body. They've got to be making their decisions solely on data, because after all, I mean, it always kind of bugs me when I start hearing about like presidential candidates or people who are already president or in office and talking about how many jobs they created and this and that and the other. They don't really create jobs at all, at least not directly. I mean, they can create, or they can make policy decisions that could lead to job creation. So you can give them that, but it's not like they got a lever in the Oval Office where they say, okay, this week let's create 10,000 jobs and pull the lever. It doesn't work that way. But in similar fashion, they can make policy decisions that could adversely affect the job market and job creation. So to that extent, yeah, maybe they have some sway, but overall, they're not directly involved in that. And the fact that they don't have any involvement in the Fed as some candidates think they should, I think that's a good thing, and I think it needs to stay that way.
Well, being like one of those reporters in the room for the third time asking, well, how will this impact homeowners and their interest rates? And I thought his response was really cool because he said, well, what we do, he said, the rate we handle, it has nothing to do with the mortgage rates. Will the mortgage rates potentially go down? He said, possibly, but that's not what this will do. Can you share examples of how not worrying about the interest rates could affect people? I think you had a saying, what you call that? It was something about roulette.
Oh, rate roulette. Yeah. Well, I was telling you a story. This week I'm handling several stories. I've got loans in process, refinance of customers, and home buyers, and their behavior has been very interesting and something I've been trying to help them with. And I'll have to admit, I haven't been entirely successful. And here's the basic scenario that we've seen in this recent week or two. I've got a refinance borrower, his loan's in process. And I suggested to him, you might want to get this rate locked. And he specifically said, no, I want to wait until the Fed meeting. I started a purchase loan beginning this week. Same thing on Tuesday. I gave this borrower some numbers that were very attractive. I mean, again, rates have already fallen. And I urged her, you might want to consider locking this. And again, she was of the same mind. No, I'm going to wait for the Fed meeting. What I try to impress upon both of them is, number one, what the Fed did this week does not directly correlate to long-term mortgages. That's not what they control in any direct fashion at all. Fed funds overnight borrowing rate's not the same as a 30-year borrowing rate. It's apples and oranges. Now, can it have a indirect effect over time? Well, yeah, sure. But what I was trying to get across to them both, and I've actually got a couple others in this regard too, who I basically said, look at where rates have been over the last month or two. In fact, with this one purchase transaction borrower, I first started talking to them about another property in June, and they're getting a second home loan where at that time the interest rate for those was in the 7s. It was about 7.25. I'm talking to her this week about 6 1/8. You're enjoying a 1% improvement in your rate over what we thought you were going to get in June, but you ended up not pursuing that house. You're now in escrow, and here you are better than 1% lower. Watch out, because you know what tends to happen, as I've seen it over 4 decades. A lot of times when the Fed makes their announcement, again, the mortgage market, bond market's already priced in that expectation. And then what happens when they make the decision and announce it, oftentimes mortgage rates get worse, not better. And that happened this week. Now, did they jump up a lot? No, but they went up an eighth. So both my refi borrower, my purchase borrower, at least as of right now, because neither one of them has locked yet still, they're an eighth worse than if they did what I suggested earlier this week. So that's the game some homeowners fall into. And I really urge them not to do that, because they're forgetting about how a rate lock can be very, very good for you to protect yourself, protect you from upside risk. And yet the industry has evolved to where you can grab that upside risk protection. And if rates end up falling, not right after the Fed meeting, but maybe in the next week or two or month, then if your transaction is still in process, you'll have an opportunity to renegotiate that and get something better. But at least your upside risk is capped, it's protected. And I actually I've got another purchase transaction where we started it about 3 weeks ago. It's going to close on Monday. And it played out that way. We locked her it was 6.125. And at the beginning of this week, I could see an opportunity to renegotiate the rate lock. So I contacted my lender and I basically submitted a request to do it. Now, there's a fee for a renegotiated rate lock. It's generally a half a point of the loan amount. And what we did is the improvement in rate was enough that I was able to kind of split the difference. And I was able to get her 5.99 without any points. Why? Because the actual market rate was 5 7/8. But by taking an eighth higher, but still an eighth lower than her current lock price, that absorbed the 0.5% fee. So it was no cost to her at all. And then after I got it done, I basically contacted her and said, okay, we're going to draw your docs now. And oh, by the way, your rate's going to be 5.99, not 6.125. She was thrilled. She thought I was like, she called me a savior. Right? She called me a savior because I saw an opportunity to renegotiate that rate lock. And I basically just did it and then presented it to her. And she couldn't be more thankful. So I think that's the way refi borrowers and purchase borrowers need to think about the rate lock decision. Don't play the market. Don't wait on the Fed. Don't focus on the Fed. If you're going to focus on anything, focus on the 10-year Treasury bond yield. Watch that every day, because that's going to give you a general idea what direction mortgage rates are going up and down day to day and during the day. That's what their focus should be on. And then take that protection. You're covered on the upside, and then look for an opportunity to renegotiate if it falls.
I think that's a great point. Hey, I want to change gears just for a second. I understand the conforming loan limit for 2025 has been announced. To what amount now?
Well, it's an interesting process, Jeff. Basically, it's because each lender can be a little bit different at this stage. So the numbers we're hearing is like 803,500.
Wow.
Some lenders are going to 802,500. Now, what does that mean relative to where we're at now? First of all, those numbers are based on what they project it's going to be for 2025. But these lenders are willing and are taking in new loan registrations using those amounts. The current conforming limit, by the way, folks, conforming means conform to Fannie Mae, Freddie Mac, the maximum loan amount that those two agencies will purchase from lenders. Well, in 2024, that's 766,550. So that's a pretty good jump, 766,550 to 803 or 802,500. That's about a 4% increase in the new conforming loan limit. But I say it's approximately where we're going to end up. Why? What happens is the actual loan limit is determined by the Federal Housing Finance Agency. That's the agency that oversees Fannie Mae and Freddie Mac. And so they announce the new conforming limit every November, late November, like right around or right after Thanksgiving week. And they base the change, I'm saying change, and I'll explain why in a minute. They announced the change in the loan limit based on an October to October change in the average price of a home, nationally. What's going on now, because the FHFA has not announced that change yet, and they're not going to for another basically almost 2 months. So why is it the lenders are already out there now promoting this new loan amount? They have access to the data as well. So they're already, what they want to do, it's kind of funny to watch these lenders. Who's going to be the first one to announce the new loan limit because they're trying to suck in more loan volume, because this is going to be helpful to the market. You can now have loans that otherwise would have been jumbo at a higher rate. Now they're in the conforming category where the rate's going to be a little bit better. So all these lenders compete to be who's going to be the first one to announce the new conforming limit. And that's been happening the last week or so. But what'll happen then is once the FHFA announces the actual number, then they'll tweak what they've been saying. And what they try to do is they try to guesstimate, I'll call it, what it's going to be. And they're going to try to be careful not to overshoot and end up taking loans that are going to end up being higher than the limit. So that's what's going on right now. What it doesn't affect is FHA loans. FHA loans are not going to change until the FHFA has actually made the announcement. So this is all about the conforming Fannie Mae, Freddie Mac limit. And it's a good thing. I mean, what this means is, for an $803,500, maximum loan amount, I mean, you can buy a home for over $825,000 with 3% down payment if you're a first-time home buyer. Now, you have to have pretty good income to cover that payment, but it's still helpful in terms of helping some of those borrowers who are good income but challenged on their down payment. Jeff, I think I've lost you.
I'm sorry. We've got some construction going on here. I was trying to knock out the construction. So does that mean a question? It's kind of selfish as a homeowner. Does that mean there's a prediction in their glass that they're looking at? They're saying that the home prices or home values are going to continue to rise.
Well, exactly. In fact, actually, what this means is this is an affirmation, Jeff, of what we've been telling our viewers for a long time. Get off the fence. Rates are a lot better. And see if you want to buy a home, get off the fence and start looking, because by you waiting for lower rates, where you've lost out is in the meantime, home prices have gone up. So this increase reflects the fact that over the past year, home prices have gone up 4 or 5%. And for some of those homeowners who are waiting for those lower rates because they were at 6 3/4 and that's too high, so we're going to wait. Well, now we're at 5.5, and so that's good. And yeah, your monthly payment might be lower, but at the same time, you may have to look at paying 4 or 5% more for the home than you would have 9, 10, 12 months ago because you thought the rate was too high.
Wow.
So this is more affirmation that despite these high rates, home prices have continued to go up. And I was referring to earlier, this doesn't always happen. I mean, I can remember, maybe some of us, many of us could, after the Great Recession of 2008, what happened to the conforming limit, for a year or two? It dropped. Because again, October to October, the average home prices dropped because of the Great Recession and home prices, falling dramatically and homeowners suddenly underwater. So it's not always assured that every year the conforming limit is going to go up. I've been around long enough to see periods where it didn't go up, it went down instead, which of course can be a big disappointment for everybody. And what that does underscore is at that time, during those periods, home prices weren't rising, they were falling. And then that gets reflected in the conforming loan limit.
Wow, that's great. Well, hey, you've done a phenomenal job of unpacking the Fed notes from yesterday and how that impacts not just the housing market, but the overall market. But particularly if you're in the market for either a refinance, you're buying a home, don't wait for one to try to outweigh the other. It sounds like, as you were saying, this is rate roulette, and it's one of those things. Are you willing to spin that cylinder and hopefully make it work out? It sounds like you better take action now. Get a hold of Art at 760-969-5023. With that, Art, I'll turn it back over to you.
Okay. Thank you, Jeff.